Today, my guest is Nick Hasckha, who's made over 12 acquisitions. He's a serial acquirer. He bought Wright Gardner, made 9 tuck-ins there, and then a couple other landscaping companies. So welcome to the show, Nick. We're going to talk to you about that.
Nice to see you. Thanks for having me, John.
So let's start from the beginning. What were you doing before you started on this acquisition journey?
Yeah, so I've had a bit of a meandering career. I spent a few years in management consulting with McKinsey, focused on Fortune 500 strategy and operations projects, kind of large scale programs. Spent a little time in clean energy and technology. Had a startup there. Worked on a couple of different startups there. And also worked with a Fortune 500 company called NRG, large energy company focused on their clean tech initiatives.
What happened to that before we go to what happened to the startup companies?
The first one we sold
Good.
to a larger company, and then the second one, it was with the same co-founder. That was an fleet electrification company. That one ended up kind of shutting down abruptly, and so was one of the 99% that fell. So.
It's not hard to be lumped into that group.
Yeah. It's a little bit of a there's a lot of luck to it.
Million ways to die in the West.
Yeah, million ways. That's right.
Yeah. So what happened next? You went for NRG, big company, and then
so I've had 2 kind of startup careers before doing what I'm doing now. The second one was the startup company that had failed that I went to after NRG. And that's where I met my now partner Anu, and we just had really compatible working styles and objectives and kind of career stage and all that, and we decided to do what we're doing now, which is acquiring small businesses.
Yeah. And when did you change that? Like, you guys screw that small startup stuff, it takes too much to get an airplane in the air and fly.
Yeah. So we were with that company from pretty early on, and grew it pretty rapidly, and basically came to the end of a fundraising cycle without raising funding. And that business, we realized we were in the same situation a lot of venture-backed startups are, is if you don't prove it, you got to shut it down. And so we were there till the bitter end, shutting the thing down. And we liked the opportunities in kind of the idea of starting a business and being the owner, and we weren't owners in that one, but we had equity, and so we liked what the pace and the work style and all of that. But I think what we were not comfortable with was getting into another 99% likelihood of failure situation. And so we wanted to have a lot of the benefits of entrepreneurship and starting something and kind of being in the ownership seat and equity and all of that, without the risks. And so we kind of reworked our objectives, and that landed us on buying a business that was already profitable. As the mechanism.
Where did that inspiration come from? I mean, did you start reading about books, or did you have some mentors that say, hey, you know what, stop the startup stuff, start buying companies that are already producing revenue?
Yeah, I had heard about it over the years. I had heard of a search fund. I haven't really read about it before, or really spent any time digging into it. But my dad I grew up with a father who was a small business owner, and he was always drilling into me that if you're not working for yourself, what are you doing? And then I had a friend who, Michael Kennefic, who I grew up with playing baseball, who started an independent sponsor and had found some pretty significant success, basically searching for businesses to buy and then buying and then working on them to grow them. And so, I guess I'd had little encounters with this idea of just buying a business that was already functioning, already profitable, through the years. And that, Anu and I, when we got our heads together and decided we were going to partner up and do something, that seemed to be the fastest and easiest path, really the path of least resistance to meet the objectives that we had for our, kind of the next step in our career.
Yeah. Now, is this a search fund? Were you financially supported by a search fund, or you're an independent sponsor?
Yeah, so we started as an independent sponsor. We thought we were going to raise money, but we ended up finding a deal that didn't really require that we raise money. We were able to put together the equity just between the two of us, and then we used a small business loan and a seller note to
An
round out the rest of
SBA?
the
Was that
financing.
SBA?
Yeah,
Yeah.
yeah.
So
So we didn't have to sell out equity outside. We didn't have to go through a fundraising process. And I think in doing that, we realized
those
like
aren't
this is
very
hard.
fun, are they?
We just realized, especially the first time, like we didn't have a real credible story to tell of, and we hadn't really even done our homework on this in terms of being able to go out and raise money and show them that we had gone through all the steps that a lot of the entrepreneurs who are out there raising money for their search funds do. We skipped all that,
Yeah, you
and we
skip.
just found a deal to buy.
Yeah. And where did you find the deal? Was it on a website, a broker site? Yeah.
It was a broker site, or Biz Buy Sell was
Biz
the,
by Sell.
kind of,
Okay. I'm
yeah.
doing a lot of promotion for Biz by Sell in the last
Okay.
20 interviews I've done, I think.
Yeah, so we found it on Biz Buy Sell, connected with the broker, told him our story. I think in retrospect and having conversations with him later, he left our conversation thinking, this is the buyer. And what I don't know what it is that we said or what it is that we did,
Intellectually overqualified, and
potentially.
probably looks at this like, I'm going to build this like massive, business with all these KPIs and measure everything with some software we code and write ourselves.
Yeah, yeah. And so for whatever it was that struck a chord with him, he kind of helped us navigate the process, help us get the SBA loan, get the deal negotiated, and get to the finish line. And that was the beginning of. And I stepped in as CEO. My partner was still working part time, but also kind of consulting on the side to support
Yeah.
income, near term income requirements,
Where did the down
because it was a
payment
small
come from?
business.
Yeah. Where did the down payment come
Uh,
from? You guys have that in between you, both of you, or did you have to go outside
so,
investors? Yeah.
yeah, a mix of savings. I had a home equity line of credit that I was able to draw because I had some equity in my house. So and so yeah, we basically just went, we were 50-50 on it,
Yeah.
and funded the equity ourselves.
Yeah. How did you guys know that you'd make a good partnership? I mean, what aside from the harmonious relations you have, like, did you ever just test yourself like in certain situations, see how you'd act? Because
Yeah,
goofing around in a bar and talking and say, hey, let's make a partnership is great until you get to a situation where you're running out of money in a company. That's when your character shows
yeah,
up. Yeah.
yeah. No, that's totally true. We weren't friends before, actually. I'd say we developed as friends, but even now, like we have a very professional working relationship. He's essentially, my partner is essentially my spouse, in the sense that like financially we are 50-50 tied together at the hip. We rise and fall together. But before that, we weren't bar buddies. He was the CFO, I was the chief commercial officer. We went through probably multiple near death experiences from a business standpoint, like the business was about to die. We had
Uh,
situations where we were nearly shut down by the regulator 3 or 4 times. And so we had kind of been through the worst of the startup ride together, and had developed a mutual respect for each other and what each of us brings to the table. And to put further light on that, I'm the yes guy, he's the no guy.
yeah. But you
Um,
guys kept your wits about each other in situations that could have been a harrowing, somebody will
yeah,
lose. Yeah.
yeah.
Interesting. Uh, and how long did you own this business before you started say, hey, let's go make some mother tuck-ins to start, building this little enterprise we're trying to do?
Yeah, not long, about 6 months the between the first purchase and the second purchase. And really, we were in contract for the second purchase probably within 4 months of the first purchase.
Yeah. And did you have the thesis? What were you going to do? You're going to do, a whole bunch of different businesses or businesses in the same niche, which could be exposed to up or downs in an industry.
Yeah, I think at the beginning, before we found a business at all, the thought was we diversify and launch a couple of different platforms over the course of however many years. We liked that the first business we were acquiring had a lot of inorganic potential because it was just a very fragmented market with a lot of small players. So we knew that there would be a lot of opportunities, and I think we didn't fully appreciate how true that was going to be. That turned out to be kind of more true than we had even anticipated. And we've been able to do nine tuck-ins over, and so kind of we did the first four over the first like year and a half though,
What did you
and
like
that
about the
was
business? What did you guys like about it? I mean, he's a
recurring.
financial guy, so he's looking at the numbers.
Yeah,
Yeah.
yeah, and both of us, I think, were pretty, had a decent amount of financial experience. He was more of like a CFO, financial operations, whereas I was more of like strategy and deal making and corporate development. But we like the recurring revenue profile. Like we had very, high precision on what our revenue is going to be this month, next month, the month after. So just a pretty tight rein on what the financial profile of the business was. We liked that the net margins were pretty good. The gross margins were great, which created some operating leverage. So as you scale and grow, it creates better economics as the business gets bigger. And the and we liked that it was a relatively small dollar item for the customers, and so it doesn't get a lot of scrutiny. It's not really you're
There's
not
not
like
a lot of
high,
friction. Yeah.
not a lot of friction. It was providing a service that the customers like and want to have, and it's kind of table stakes for running an office in the Bay Area. A lot of money was flowing into the commercial office market, really thick commercial office market here in the Bay Area, just hundreds and hundreds and hundreds of companies. This business did really well with the small customers. And so the Bay Area there's just tons and tons of small companies.
Yeah, yeah, tons. Did you, when you bought the company, did you fill in a role and say, "Hey, I'm not going to tell people what to do until I do it myself. So I'm going to go out to an office, try to sell some plants, uh, decorative plants, and see what that whole
Yeah,
process is like."
yeah. I was our only sales guy for the first month. The seller trained me to do sales, and yeah, I mean, I started on day one. I knew zero, like I didn't know the names of the plants, anything. He taught me how to sell, how to specify, and then we had a sales guy. We had a sales guy who was out on disability leave, and once he came back, then we had a real salesperson, which helped me kind of get out of the focusing 100% on sales. The nice thing about recurring revenue is you don't necessarily have to be out selling every day, because um,
They're just paying
tomorrow's
for it. You just keep,
today's
yeah, yeah,
sales is tomorrow's growth, but today's sales isn't. You don't need to be constantly backfilling your operating capacity
yeah.
with new sales. Sales is growth, not. Um,
Yeah. Let me ask you
so you
about
have that nice base.
expenses, because I would say a CFO for a startup is pretty high dollar amount. San Francisco Bay Area for a technology company, 150, 175K. Was that how was he adjusted his salary to fit into as a maybe just accounting for this couple $1 million gardening company? Yeah.
Yeah. Yeah. So, I mean, we both had to moderate our expectations in terms of how much money we were going to make for a handful of years. Both of us had, working spouses. So we had a little bit of a latitude there
Gotcha.
to be able to flex down and not take such a large income requirement. Because make no mistake, we would have made more money working for somebody else
Absolutely. Yeah.
for a year, probably for quite a few years. But it was an investment we were willing to make in ourselves. It was an investment we were willing to make in the flexibility that we have day to day.
Yeah.
And so, yeah, that's a sacrifice and a compromise we
So
were both eager to make.
did you immediately set out and say, "Hey, we're going to start doing some tuck-ins," or say, "Well, why don't we just grow here?" Or are we these tuck-ins to say, "I'm going to buy the business and shut them down," or just what did you do with these?
Yeah, so the tuck-ins were acquisitions of accounts and staff,
Yeah,
and so
you just bought their book of business, kind of.
we bought their book of business. The situation was the market was very fragmented, and a lot of the owners that remained in the market were running businesses of a couple of employees and decent size, varying in size, but decent sized books where they were able to make enough to live. But it stacked nicely onto our book, and we were able to get some scale economies of operating within a constrained geographic footprint. So we would, for instance, we buy a book of business where I already do floors 1, 2, and 3, and the guy we're buying out does floors 4, 5, and 6, and all of a sudden I got one tech going to all 6 floors in one building.
How
And
were these guys actually real businesses, or how did you find them? Yeah.
yeah, they're real businesses, a mix. I mean, one of them was referred to by our SBA lender who said, "Hey, I just loaned to another guy who bought the business." So he referred us to another brokered listing. So we saw it very early and was able to get it under contract. We were, I guess, just we were making it known that we wanted to be buying these things. So we talked to our upstream suppliers, our nurseries, saying, "Hey, if you know of anybody who might want to sell, we're interested in buying." So yeah, we were one of the younger groups that had kind of made our desire to acquire books of accounts known, and that helped us generate the interest, generate the ideas, get out there, talk to the owners, and make deals happen.
Yeah. What were those? I mean, those tuck-in sizes. We talking about 50,000 to 500,000 kind of size revenues?
Yeah, I'd say yeah, that's about right.
Yeah.
And generally, our we were not making big tuck-ins relative to the size of the business. So we weren't doubling the business. We were adding 10%, adding 20%. I think the biggest we ever added was around a third of the business we added in one tuck-in.
Yeah. Were
Um,
they making money, profitable, or some
yeah,
mixture of not profitable?
yeah, it varies. I mean, a lot of them, they're really the desirability of of any acquisition on its to acquire in and run as a standalone business. How desirable that is kind of depends on how much the owner's making. If the owner's making 50,000, yeah, that's not a real. You're basically buying a job, and it's not a real desirable job because it pays 50,000 at best, right? That's if you
Yeah.
don't take any debt, if you have no interest expense, no. So those tuck in very nicely because that just adds to the bottom line, and there's nobody else to buy them really because nobody wants that job, or very few. There's just not a lot of people
And
who
the
would
owner's
want.
like trying to figure out how to get rid of it.
Right. Yeah. So we did a
Yeah.
lot of those, and those work really well for us. We did a couple bigger ones that were like real businesses that the owners had made a good living and they'd made a good go at, and they were they were well into the six figures, but not like not making $500,000 a year, and they're making like what they would make if they were working for somebody else.
Yeah. Yeah.
Um, and the I mean, those also are good. Those are a little bit more desirable. They cost a little bit more in terms of how many years of owner earnings you need to pay to get one of those. Um,
And by that time, did you use the same bank, SBA bank, or did you use your cash
yeah.
flow from the business?
Oh, yeah. For most of the tuck-ins, we didn't actually never went back to the lender. We've been doing the rest of the tuck-ins because each of them was small relative to the business. We've been able to fund with balance sheet and seller financing.
Oh, okay.
Um,
How much seller
or
financing?
It varied a lot by the business, by the portfolio, how attractive the portfolio is, like how long the clients have been there, how well they're priced, a wide range of, and how much we wanted the accounts. Like some accounts are more desirable than others. Restaurants are problematic. Hotels are much more likely to churn. So we kind of weight the portfolio and figure out like how much are we willing to put down in cash because that's money that's gone forever. And then the seller note, we've been doing more of like an earn-out commission structure on the seller notes of late.
Uh,
So it creates a little bit more flexibility in what the repayment looks like, and it aligns our interests with theirs.
which
Because if
scenario earned a better higher earn out or sell earn out?
the commission, I think, is a better
Yeah.
deal
Yeah.
for
I
them
mean,
for
like
sure.
which one? Like a better high commission? Oh, I see what you're saying. Yeah. Gotcha.
Yeah, so if I do a low down payment and a high commission rate, provided we do well with the business. We haven't done well with all of them, but I mean, we did badly with one we closed on February 28th, 2020, because it was a hotel and restaurant portfolio that was all gone within like
Oh
30
yeah,
days of
very quick.
close.
People stop traveling. Yeah, but a lot of offices in San Francisco too. How is that affecting you?
Yeah.
Yeah.
Yeah, that was a pretty brutal reckoning. We were down a lot, very very quickly. Um, there were others who I know in the industry who I keep close with who are down more, um, and it was really just a function of our team quickly retooling the operation to operate in the new environment. And but yeah, it was very very painful March, April, May of 2020.
Yeah.
And that actually got us to go buy an outdoor company because we were trying to stabilize the revenue. We had no idea how far it would fall, and over what time period.
Yeah, at some point in that COVID thing, we're just like, is this the whole thing going to collapse? Yeah.
Yeah, and that was before we knew what the financing was going to look like and all that. And so we went out very quickly and got an outdoor company under contract, because that basically set up a floor for how far we could fall.
Yeah. This outdoor company, it was a landscaping company.
It was an outdoor landscaping company. It was a little bit of a turnaround situation. It was, I'd say, failing slowly. Very owner in his late 70s, great guy, a
Just
wonderful seller to do
absentee
business
kind of
with.
owner, not pushing it. Yeah.
Yeah, and like he didn't really want that much more business. He kind of had all he could handle. He wanted to reduce his hours, and he was taking care of the clients and the employees that, as best he knew how. But the world had kind of lapped him as far as his business career went, and he was no longer interested in running the business anymore, and his kids didn't want it.
Yeah. Where did you find that? It was a
It was another broker, just a broker that we knew and we'd talked to before about other deals. And I guess he thought of us when he saw it come up for sale, because he gave us the kind of the inside track on it before he even had it listed. And so we had it in contract kind of right away.
right
The
away.
moment we saw it, because we'd seen some other outdoor businesses.
Was this another SBA loan? Big,
We did that one with balance sheet.
just your balance sheet and cash flow. Okay. Yeah.
Yeah.
You didn't put a lot of cash down on it, or was it more? So
No, that one we put cash down, or we pretty much did all cash.
yeah. How did you guys change your when you're voting for your pay stub? You're always going to vote. It's like members of Congress. Well, let's all vote for a 15% raise. How did you guys do that?
Well, for us, that comes in direct conflict with what we would like to be doing, which is investing,
Yeah.
and investing and reinvesting. And so every dollar we take out of the business is a dollar we can't invest. And so we take out what we need, but not what we want.
But expenses living in California, Silicon Valley, it's expensive.
Yeah, no doubt.
Yeah.
So yeah, I mean, we haven't like adjusted our life really at all, and we just kind of have the same needs that we had a year ago and 4 years ago and 5 years ago, and some stuff costs more, and so we try to make some adjustments there. But for the most part, try to kind of just very much live within our means, and any extra cash flow gets reinvested.
Yeah. So this landscaping business, how long have you owned it? And you said you sold it? You did sell it?
We did sell that. So we kind of turned it around. We brought on a manager. We modernized it, because it was run pretty old school. We were able to do one more tuck in, which was actually the seller's brother who ran a competitor.
Okay. Yeah.
A smaller business. We put those two together. And then I think once we realized that it was easier to fix than to grow, and how difficult the growth path and how cash consumptive growth was going to be in that business, because it was pretty small still. And there were a lot of much bigger competitors.
Was it more expensive to grow, like go out and get new accounts? That's why you
yeah, and very expensive to grow. Adding crews was expensive. There's a lot of regulatory uncertainty, and actually, I mean, that really came through while we were in contract with the
that's like lawns with gas motors, right? In California.
Yeah. $5,000 gas mowers that break, and then California says, hey, and you can't buy those anymore, and you have to buy this $30,000 one instead, because it's battery.
That's crazy. Yeah.
And you got to upgrade your facility infrastructure, because you got to buy all these extra batteries. And so it was going to require a major retool of the operation to electrify the whole gas equipment fleet and transition it to electric equipment. Plus, then they came down with another egg to ban all watering of commercial and industrial properties. Well, guess what properties we serviced? Commercial and industrial properties.
Holy crap.
Guess which properties will all die without water? Those ones.
Yeah.
And so the landscaping industry is going through a pretty massive change here in California.
Ouch. That's
between those two things. And so I think we were not interested in being along for that ride.
You didn't
and
load the business that much to get $31,000 batteries.
yeah, yeah. And so, yeah, that gave us, and we found a good opportunity to exit the business with and put it in great hands with another landscaping company that is really, really good.
Yeah.
And
Did you make money on your investment?
yeah, yeah, we did reasonably well with it. And I'd say more importantly, like I feel really good about where it landed too, just in terms of the people, the clients. Like I
Yeah.
feel like we created, I think, a lot of opportunities for the people who stayed with the business to transition into new roles, better roles, make more money, do better. So I think all around, like every stakeholder in that transaction is happy
Yeah.
with
So
how it
what are you looking
unfolded.
for now? I mean, you've got Wright Gardner, which delivers
Yeah,
plants and
yeah.
more
So
plants to commercial buildings, offices. But what's next?
yeah, so I've been leaning into that a bit more, getting back and trying to figure out how to try some new things to grow that. I think that can only grow so fast organically, and the inorganic opportunities are starting to come fewer and farther between, since a lot of that opportunity has been captured and a lot of the ownership market has turned over. And so, yeah, it has me looking for new things, working on. I kind of start with a macro thesis of kind of where is the world headed, and then specifically, what does that look like here? And how is that unique from what it looks like in other places? And then
Yeah,
how do
well,
I
it's
turn?
different in Silicon Valley than the rest of the
Yeah,
planet. Yeah.
yeah, yeah. And so then turning those macro thesis into kind of a local thesis, and then that local thesis into a, well, here are the types of businesses we want to buy, and let's find some examples, and then go talk to the owners and see where that takes us.
Yeah. And that's off market, or are you kind of perusing biz buy sell or both? Yeah.
A bit of both. I think I have the luxury of time now because we have an existing operation, and I don't have a big rush. Whereas at the beginning, where you don't own anything, you don't have anything, nor do you have any income.
A
There's kind of
little
a big
sense of
rush.
urgency, yes.
That's a real sense of urgency. Here, I think we have the luxury of time to be able to wait for the right thing and make sure that it's exactly the right thing. Do a little bit more homework, make sure we get ourselves into a good position, and don't make any mistakes, and find something that we can hold and grow for the long term.
So what are the, I mean, aside from outside economic forces that kind of change your direction, you didn't make any other mistakes that you go, man, now I'm wiser.
Yeah, I think we didn't really study, nor did we really have time to study the competitive dynamics of the landscaping industry. So I don't think we realized like how brutally competitive it's going to be, and how much we were going up against some really, really good landscaping companies.
Yeah.
And not knowing all that much about landscaping going in, that's a huge disadvantage. We were able to hire, to fill some of that gap, but there's really no substitute for the business, for like really knowing the business you own inside and out at the beginning, so that you don't have to make mistakes that, you know, have been made over and over and over and over
Yeah.
again by
That is, I
everybody
mean,
else.
that is being in the industry and understanding who the players are, the other players on the other side, going, okay,
Hmm.
they know what's happening in the legislature in Sacramento, are going to, they know it's coming and they may be prepared for it, or they're waiting for all the other guys to just die out.
Hmm.
The
Yeah,
weakling.
no, that's true. I think it got us thinking more carefully about what niches are make good niches for a small operator like us.
Yeah.
Um, Things that are not going to be nationally competitive, nationally interesting. We don't want to get steamrolled by some national private equity firm rolling up all the locals, or we want to focus on in places where we think we can compete and win, and that have a good fundamental outlook, but not so good that Carlisle Group's looking at it.
Yeah.
Um,
Yeah. Any industries you like, laundromats or self storage or anything like that? You,
Yeah, I can give so a couple of examples of things we're looking into. I think we see the seeds of change going on in the water industry. So I think there's a lot of interesting things going on in water treatment and kind of generally the water space, just because of drought, regulatory change, legislative change. So I think that can benefit people who really know the space and have a business infrastructure and kind of know-how around water treatment, and there's a variety of different applications and business models in that space. But so we're looking closely there. I mean,
But
it's
not
a
a
bit unique to the
startup. You're
West.
just like, you're gonna like picks and shovels
Services,
already. Yeah. Okay. Gotcha. Yeah.
yeah, picks and shovel services, um, a knowledge base. There's some technical stuff to it, and having a bit of an engineering background is helpful um, in that space, which creates some opportunity for some advantage. Um, the Bay Area biotech scene is really booming, and specifically around lab R&D. And it seems like that is, if you could similarly finding kind of picks and shovels business models where you're selling into that market, selling services, all sorts of unique requirements for these types of spaces of how you operate a biotech R&D lab. And those will vary depending on whether you're specializing in, lab diagnostics, therapeutics, plants, genomics, all sorts of different versions of biotech. And depending on, where you're focused, and
Yeah.
that can create some really interesting opportunities to serve into that market. And
And
then the third one
you
is
have the
around,
time to figure
okay.
that out. Yeah.
Yeah,
Yeah.
and that's the luxury of time, right? Is we can spend our time studying these industries and figuring out who's got business models that we like, and who's got, who's small now but may not be small in the future because they have a certain expertise, and when targeted at a fast growing market, could have the opportunity to really amplify it and scale quickly. um,
Yeah.
and then the third one is around labor. We have a thesis around labor. Labor scarcity is not going away anytime soon. And so figuring out locally, especially, what are the unique labor needs that are here, and how do you get into the labor supply chain?
Like a
Everything from,
recruiter or something. Yeah.
could be recruiting, could be staffing, could be training,
Yeah, I
could
remember a guy,
be,
I had a buddy that used to do recruiting in Silicon Valley, and he said, "Look, it's zero startup cost because it's just a phone, and then you could make 200,000 a year just putting engineers over here and over there and over there."
yeah, yeah. And then I think within that, finding the really specific niches where you can develop unique relationships and not have to. So I think we're looking for things that are fundamentally less scalable, right? Things that are not nationally or globally scalable. We don't want to compete nationally, or globally.
Where
We want,
private equity dips their toes in. Yeah,
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 we would prefer to compete locally and use the fact that we're here not as a disadvantage, but as an advantage.
gotcha. That's an interesting way to put the thesis. What's the Cub Investments? What are you doing there? You are starting a fund to.
Yeah, no fund. It's basically just our identity as investors. It is us as, making investments in small business across, these different kind of different ideas and theses. We've got some investments with some other operators who think similarly to us. We do a little bit of board work, have some kind of more passive equity investments in similar ventures as the one that we operate ourselves.
Yeah. Does Anu work for the company full time, or is he still doing a little consulting for high tech?
No, about 2 years into the Right Gardener, actually, we switched spots. He took over as CEO, day-to-day operator of the Right Gardener,
Yeah.
and I spent my time hunting for new stuff and coming up with new ideas and trying to figure out where we're going next.
Yeah.
And I still do some project work. Like, I built the software for the Right Gardener, but um, I have
Well,
been
what
doing
kind
a
of
mix
software?
of
CRM software or something, or what?
mostly field management. At least that's what we built from ground up, which is field management software for managing all the accounts and managing the service of indoor plants.
Yeah. Is that something you're going to start selling to other places with?
I don't think so. I don't really want to be mission critical in anybody else's operation. I'm nervous enough about mission critical, being the mission critical software engineer in my own system,
Yeah.
but so far it's worked out great. Being able to customize it and move fast and adapt to the operational needs of the business, has been a huge competitive advantage, and allowed us to like move quickly and scale up our operation and improve our speed and accuracy with everything we do in the operation. So, and me being able to deliver that functionality to the team has been really useful, because like with COVID, we had to redesign a whole lot of it. Which we were able to do
There
quickly because
wasn't anything off the shelf that did with nothing.
There are things that people have made fit. Like I've talked to plenty of competitors. There isn't really anything that has that people have the confidence in that will exist long term. Because that's the other thing. If you're going to run your business on it, you better be darn certain that it is going to be around forever.
Yeah, yeah.
Because if you become very, very dependent on it. And so we
Well,
got to the point where
the
we're like, there's
challenge
nothing.
is that, you know, if you decide to sell and you get into 50, 60 years old and you goes, oh, they have this antiquated legacy system, right? That means the new person has to go recode everything or buy something off the shelf.
Yeah, I mean, I think the no code tools are getting better and better. And
Yeah.
so I think the ability to customize your own software and kind of work with drag and drop tools. I mean, that's what it's built on. It's built on the
Oh,
system
okay. I
we
got you.
run is built on Google, as a Google tool set,
Oh,
a low code tool set that it would take a little bit of time for me to onboard somebody and to learn how to operate it, fix it. But it doesn't really break. It's pretty robust at this point. And so, but if we were to have to totally rework it or redo it, um, it would be a lift, and most people would need to hire some outside help to do it. And I could do that too. So
yeah.
I don't know. I'm not too scared about it.
Too
It works pretty
concerned
well
about
for us.
something
And
that's way down the road. Anyway, let me ask you about this, like who you were in the startup scene, failure, non-failure, that person, Nick, who you were to today. You're like an acquisition entrepreneur that's done over 12 acquisitions. And you like this, Nick? Is this the Nick you like? Happy and good,
yeah,
make you a good self, good husband, good father, etc.
yeah. I mean, I've changed a lot. I had one when we started this. I had one child. Now I have three.
Uh-huh.
And yeah, I mean, overall, I think I've been really happy with the trajectory. I'm really happy with the partnership. And I think it has me doing what I'm best at, and which is sort of pursuing, finding opportunities and executing against them. And it's a little bit different than being in the startup world, but not entirely different. And so there's definitely a lot of similarities. But it's certainly playing with your own money is at times it can be a little bit more emotional and take some calming down when things aren't going your way,
Yeah,
because
you ask
they
a
won't
number
always
of
go your way.
questions before you write a check for when it's your own money. Like, we're never going to get that money back. So let's
Right.
ask ourselves a couple questions.
Yeah.
Yeah. Nick, I really, really appreciate you being on the show today. So thanks so much for being on the top M&A entrepreneurs.
Thank you, John.
All right. Take care.
Take care. Bye.
And hope, man. I hope this video has inspired you. If you need help buying your first $1 million business, make sure to visit me at dealflowsystem.net. If you like this video, make sure you subscribe down below. Comment on it, share it, tell everyone about it. And thanks for watching.